Hello and welcome everybody to this weekly market recap for the week ending Friday, January 2nd, 2026. It's weird saying 2026. Happy New Year to everybody. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. It's always a pleasure to be with you in this course, our first recording of 2026. Not a whole lot's changed, I can tell you that. Been talking a little nervously about the market and really got nervous when I saw that 26 Wall Street analysts out of 26 are calling for higher prices in 2026. Kind of interesting that there are 26 of them in 2026. But anyhow, that always makes me nervous because you never know what they're doing. You can't base it on what they're saying, that's for sure. So I got some interesting charts I want to show you. We got a big event, big event coming up tomorrow, Saturday, January 3rd at 10 a.m. Eastern time. I'm going to talk about that in just a little bit. Even if you can't make the event live, we do record it for those who are registered and can't attend live. So you can go back and check it out at your leisure. I would certainly highly recommend it. If you want an objective opinion, I'm going to give you one tomorrow. Anyhow, bunch to go over today, but I do want to, wish everyone a happy new year. Here's to health and happiness and prosperity for the year ahead. We're going to be there every step of the way. We'll try to give you, our take on the market as we always do. And hopefully we'll be spot on as we have been for the most part for the last several years. But here's to 2026. All right. So let's check out, what's going on. Let me pull up the charts here for you. So this is a chart again for the last week. So this isn't just today. This is for the last week. Transports leading, dropping 0.6%. So you can see all the major indices have been down for the past week, which is noteworthy because this includes the Santa Claus rally period, where we typically see a nice move to the upside between Christmas and New Year's. We did not get that this year. I think that is noteworthy because normally we do get some sort of strength, and we really haven't seen much here over the past few weeks. But anyway, transports down 0.6%. Dow Jones down just a little bit more. S&P 400 mid cap down 0.7%. The S&P 500 down just a little over 1% this past week. Russell 2000 also just a little over 1%. The NASDAQ 100, which is where a lot of those large cap growth names reside, NASDAQ 100 down 1.7%. So seeing a little bit of skewing away from growth still over the course of the last week. And that's been a problem. And I've got a big chart I want to show you a little bit later in the show that kind of hopefully will illustrate a little bit why that can be very meaningful. All right, let's take a look at these sectors. So energy over the course of last week gaining 3%, a little over 3%. That was clearly the big winner. Utilities, industrials, materials. You can see we're looking mostly at value-oriented stocks or defensive stocks. And that's a little bit of concern because, again, that's where we've seen a lot of the money rotating. Those were your only 4 sectors that actually went up last week. We had 7 that went down. And part of the problem with the S&P 500 is that 3 of them that went down, consumer discretionary, technology, and financials, are among the aggressive areas of the market. And one group that barely outperformed the S&P 500, but still finished red, was communication services, which is the 4th of the 5 aggressive groups that I like to follow. So this past week has been led lower by some of the key aggressive areas of the market. And that is usually a problem when you're trying to move back up and set all-time highs, or when you're up near all-time high territory, because that's when Wall Street moves. That's when Wall Street moves their money and gets prepared for a potential drop. So this rotation occurring as we're at or near all-time highs, there should be some red flags, on your radar. And if not, again, you'll want to check out our Market Vision 2026 event on Saturday, because I'll be going over some of the warning signs. But let's keep moving. Got a lot to go through. Don't want to spend a whole lot of time here today. S&P 500. I wanted to point out to you a couple of things. First off, back on October 27th, the S&P 500 closed at 68.75. And you might say, well, What's so big about October 27th? What's the deal? Well, I can tell you that based on the last 75 years of history, the most bullish period of the year for the S&P 500 begins at the close on October 27th and runs through the close January 18th. It's so bullish, in fact, that 66 of the last 75 years, the S&P 500 has closed higher at the end of that period than where it was at the beginning of the period. So during that 2 months and roughly 20 days, we've seen the S&P 500 climb during that period 66 of the last 75 years. Now, let me just tell you, and this is something I'm going to go over in the event tomorrow, but of the 10 worst years, the 10 worst October 27th close to January 18th close, the 10 worst of that period over the last 75 years, do you know what the next year did the following year? 6 of those 10 poor performing fourth quarters and into early first quarter of the next year, 6 of those 10 years saw negative returns the next year. Actually, I believe 6 of them had negative returns of 10% or more. 2 of them had minor negative returns. One was up 9%, the other one was up 14%. There is overwhelming historical evidence that points to a poor fourth quarter or poor October 27th to January 18th period. That points to weakness in the year that follows. Now, where do we stand right now? Well, we just started January. January 18th will be 17th will be a Friday in 2 weeks. So we got 2 more weeks of action before we close the books on this historical period from October 27th, 2025 to January 18th, 2026. Where are we at right now? Well, we started at 68.75. Right now we're at 68.58. We're down 17 points. This is very unusual. It has not happened often at all. And it has a very strong correlation. If things don't pick up over the next 2 weeks, if we get off to a rough start here in January, I'm just telling you what history tells us, which is we should not be expecting a whole lot in 2026. But I'll leave you with that. Just something to think about over these next couple weeks, depending on how the S&P 500 turns out. Now, this week, today, let me just go with what started working today. So this is the first day of 2026, and I saw aluminum. First of all, coal. Coal's very volatile. It could be the number one performer, outperforming the S&P by 7% today, be down 15% tomorrow. I mean, it's all over, back and forth. I really just tend to ignore coal. But a few of these industry groups did catch my eyes. One of them, aluminum, outperforming by more than 6% today. Steel outperforming by 3.3% today. And then also oil equipment and services outperforming by 4.3%. Let me show you why they're catching my attention. Here's aluminum. I mean, you can see the absolute chart here, and this is the relative chart to the S&P 500. I pointed out aluminum here last several weeks to our members at Earnings Beats. Aluminum has been performing exceptionally well, and it is really starting to strengthen. Now, I don't know if some of these commodity prices, if we start seeing strength, whether that might lead to another jump in inflation somewhere down the road. Who knows? But it's worthwhile noting that we're starting to get a significant push up in aluminum. So maybe some of the aluminum stocks, something you might want to consider. Also, steel. Look at steel, which made a breakout back at the end of November, continued to try to push higher in December. And now we open up the year breaking out to another new high in steel. Look at the relative strength over the last couple of months in steel. So these are 2 areas that have started to perform really well on a relative basis. And I'll give you this third one. Oil equipment and services broke on a relative basis today to the highest level that it has seen, once again, on a relative basis, highest level it has seen since all the way back in April, since we were at that low on the S&P 500. Now, we did not break out on an absolute basis, although we're close, but this is an area of the market that is showing some strength. I wanted to point that out as well. All right, here's a warning sign I wanted to point out. This is something, again, I'll talk about more tomorrow. Perspective is something that most traders, most investors do not have any of, or very little of. When the market's on fire and moving up, all we think about is it's how it's going to keep going up. And when the market's going down, we don't care about the fact that we might be at historic lows in terms of 2 or 3 year returns, which normally means we're going to, have a move back, to the upside. A lot of folks don't use perspective. I think that's one thing that we're really good at Earnings Beats. Let me just tell you, here's an S&P 500 chart, monthly chart going back 75 years. And down here at the bottom, this is a monthly chart, and I have a rate of change of 36, which is 36 months. That's a 3-year return. So we just closed out 2025. This is now 3 years in a row of double-digit performance. 2023 and 2024, we were up over 20% each year on the S&P 500. In 2025, it was more like 17%. So what does this mean? Well, it means that for the last 3 years, back in October, when we hit that all-time high in October, this 3-year moving rate of change went up and almost hit 90, almost went up 90% for 3 years in a row as of October. Now, why is that important? Well, if you look back the last 75 years, that was only the 6th time we've ever done that. Take a look at what happened the other 5 times. 1956, we got up through that level. Look at the next year. We had a cyclical bear market. How about 1986? We got up there. What did we have? The 87 crash. The late 90s, we got up there and pretty much stayed up there for a year and a half, 2 years. What did we have? One of the worst secular bull markets ever, or bear markets ever. 2012. Now, this time we touched it. We kind of went sideways a little bit, but we kept moving up. And I think part of that was we weren't even at an all-time high there because of the secular bear market that we were in. A lot of this gain was really just coming off of that historic low that we had back in 2009 from the financial crisis. So I kind of give a little bit of a pass to that one. How about 2021, at the end of 2021, after the huge pandemic run-up, post-pandemic run-up? What do we have? Pretty nasty cyclical bear market. And now here we are again, going into 2026. I mean, I just ask you to look back. This is just perspective, folks. The market goes up 9% a year on average. When you go up almost 30% over almost 90% over 3 years, that's getting close to like a 30% a year kind of rate. When you only average 9% over 75 years and you keep tacking on 25, 30%, it's going to catch up to you. And eventually you might be really bullish, but the gravy train's going to run out. Anyway, something to think about. For those of you that are new to Earnings Beats, first of all, I think we have a unique approach. I think we combine a lot of different stuff, fundamentals. I'm a CPA at heart. I was in public accounting for 20 years. So I'm really strong on the fundamentals, but I'm also a technician. So I like to follow the technicals. I also like to follow sentiment and history, not to mention using a healthy dose of perspective. So if you like the way we approach the market, number one, like this video, subscribe to our channel. And then when you're at earningsbeats.com, I want you to check out our Market Vision 2026 event, which will be Saturday morning at 10 a.m. Click this link. This will bring up this page right here. You can register. When you sign up for this event, we're going to give you a free annual membership to Earnings Beats. And trust me, that gets you a lot for the next 12 months. So make sure you register now, get ready for the event tomorrow, and then sit back and relax for the next year. I'll keep you posted on what I'm seeing throughout the year, where I think the market's going. I'll update periodically, my forecast that I'm going to provide tomorrow. It's a great time to check it out. If you are on your mobile device, you can click or just scan that QR code on your screen and sign up on your mobile device. It's that simple. Two more charts and we're going to wrap this thing up. First one, equity only put call ratio. When the equity only sentiment moves strongly in both directions, but it reaches extremes. When it reaches extremes on the 1 year moving average of the equity only put call ratio, it's time to take notice. When you reach a high and you roll over, that means that the market's grown incredibly bearish, meaning that there's just no more room to the downside. And when this rolls over, you want to be in the market. Look at every time we've rolled over and gone down. Check out these blue directional lines. And it shows you this is what happens to the S&P 500 when the market becomes so depressed and so pessimistic. There's no more sellers out there. And so that's why the market rebounds. Well, the opposite is true when the market grows too optimistic, too complacent, and you get to a low where those equity only put call ratios have been low for an extended period of time. And when you start to turn back up, turn up, turn up. I didn't circle that one, but turn up. And now we're just now turning up this year. When we're going higher, look at what the S&P 500 does. 2011, nowhere, sideways. 2014, 2015, correction at the end of that period, but basically nowhere. How about 2018 into 2019? Cyclical bear market, but essentially went nowhere over the course of the next year. How about 2022 when we turned up? How about a 30% drop, cyclical bear market? Well, guess where we are right now? We're starting to turn up. At the lowest point that we have been in the last 17, 18 years, with only one exception when we went through that pandemic low on the equity only put call ratio. So this is telling me, hey, you might want to be careful. It's just throwing out a red flag there. Last chart I'll give you. This is one that I really like to follow closely. The XLY XLP. I have a user defined index where I just track the XLY XLP intraday and ignore the gaps because I can see the rotation taking place. Before we topped in February 2025, look at how this had already turned down. With gaps, if you, I said excludes, that actually includes gaps. So that's just a typo. This includes gaps. So what's happening is that the XLY is continuing to gap higher, which draws a lot of folks in like you and me that aren't paying any attention, don't know how to read the under the surface signals. And then after they're done chasing these gaps, then the market falls apart and comes down. But this is how the top, look at how the top looked from December to February, kind of going down, coming back up, barely trying to set another high. This had already turned down significantly. This was just starting to turn down. Look at where we are now. Does this not look almost exactly like what we saw a year ago? And look at this, lower lows and lower highs been going on now for 3 months. We rallied back with the including the gaps, XLY XLP ratio, but we haven't broken out. And now it's starting to roll back over again. If the market starts to sell off, don't forget this conversation. That's all I'm going to say. Hope to see you tomorrow at Market Vision 2026. I'm going to probably be sharing 50 charts or more. A lot of things to look at. I'm going to be talking about international stocks. I'll be talking about the bond market. I'll be talking about the dollar, gold, silver, cryptos, you name it, everything, all the different sectors, the overall market. I'll talk about sentiment. I'll talk about history. I'll be talking about what makes up bear markets. What do they look like? A lot of stuff going into tomorrow's presentation. Everyone always loves this. We get very high marks. You don't want to miss it. Make sure you get registered today, and I'll see you tomorrow. And again, Happy New Year, everybody. Happy trading.